Hello, welcome to Mali Investment Talks. My name is Joseph Areu. I am your investment advisor, passionate about giving you tips about investing or passive investing for financial independence and security. So, welcome once again. Ladies and gentlemen, today or in this video, I would like us to talk to you about portfolio, your asset or investment portfolio, and to give you some tips about how to manage and to allocate your portfolio. Of course, for details, always remember to get in touch with me. But even before you do that, always remember to like, to share, and to subscribe to my videos, okay, so that you are always in the picture of what is going on. So yes, we want to talk about your portfolio. You know, ladies and gentlemen, in the long run, the important thing about your investment returns is actually your portfolio, more than or over and above your individual or specific assets. So what do I mean by a portfolio? So if you have different assets, maybe you have some shares, but also you have some bonds, you have some real estate. If you add together the valuation of each of those, the total sum of that valuation then becomes your portfolio. So it could come to, for example, 1 million rand or 100 million naira, a billion Uganda shillings, 500 million Kenya shillings, and so on and so forth. It is the performance of that overall portfolio in the long run, which is then what we should be thinking about. So you could have one asset maybe not performing well, but another one is performing well, and in the end, it is the overall average of that portfolio that is important. And so what you want to do is to manage the performance of that portfolio in accordance with your priorities and in accordance with your risk profile. So if you are a low risk person, you want to make sure that you are not overexposed. You don't have too many very high risk assets in your portfolio. If you can tolerate a lot of risk, then you can have a few assets which expose you to a little more risk, but in exchange for hopefully a higher return. All right. So the whole idea about portfolio asset allocation is to determine what percentage or proportion of your portfolio should go to different asset classes or different geographies or whatever, in accordance with your own risk profile. That is what we're talking about. And to determine the specific allocations, ultimately, I would advise you to be talking to your investment advisors. Those of you who want to get in touch with me, more than welcome to do that. But today, I just want to share with you high-level tips about managing your portfolio. So remember, in the long run, especially when you're talking about passive income, the goal of managing your portfolio is basically to attain financial security or independence over the long term. It's not necessarily to become rich, but it's more to avoid becoming poor, to avoid becoming financially delinquent. That, in the long run, is your objective here. So what are the basic things that you need to do to manage your portfolio? So remember, managing your portfolio, allocating assets, it's essentially about spreading risk over different securities while controlling whatever you can control. So controlling costs and taxes and things like that. But you basically try and spread risks over different asset classes, different assets, different geographies, and so on and so forth. So there are basically four things that you want to remember when you are managing your asset portfolio. Number one, like I said, you want to spread your assets across several or multiple asset classes. And you make sure that the classes you are allocating to do not behave in the same way, do not have the same risk profile. So what do I mean here? If you have an asset or an asset class which performs badly in tough economic times, well, then you want to have another asset class which actually performs well in the same environment. All right? So if you have shares, for example, the economy can easily affect the performance of companies badly. So then, if you are going to diversify, you don't want to be in another asset class which also behaves in the same way. This is what we call, in technical terms, sort of autocorrelation. You want to avoid that. Number two, you want to avoid too much concentration within any asset class. Okay, even if you spread, but then if you have like maybe too much, I don't know, 40%, 50%, depending on what your advisor will have told you in any one asset class, depending on your risk profile, that would be bad for your portfolio. Okay? So if, for instance, you are a low risk person, then you want to be sure that you don't allocate too much to high risk asset classes like shares, for example. So you might then want to contain it to, I don't know, 10% or even less, depending on your risk appetite. Number three, as I've just said, you need to try and control your portfolio costs, the cost of investing in your portfolio. So if, say, you have assets in a managed portfolio, like unit trusts and so on and so forth, you want to check what, for example, are the management fees. One might be charging you 1.5, another one charging you 2%. That difference is very significant in the long term. So you want to keep your costs low. Number four, and finally for today, you want to do what we call portfolio balancing. In other words, at different points in time, as often as is possible, make sure that you readjust and reallocate or redeploy the funds in your portfolio in such a way as to maintain the acceptable balance, acceptable proportions of different asset classes in accordance with your risk profile and your priorities. So if, for instance, you determine that you need to have no more than 10% in shares and maybe 90% in fixed income. And then a year later, because share values have gone up, you suddenly discover that, oh, now you have 30% of your portfolio in shares and you have only 70% in fixed income. It is time then for you to rebalance, sell some of your shares so that you bring the proportion of shares back to the 10% which it was meant to be in the first place, and then buy more fixed income assets in order to keep your portfolio where you want it to be. That is what we call rebalancing. Ladies and gentlemen, that's what I have for you in this video.